Welcome back. This is Chili Davis, and I'm back to do another video. I want to welcome back all my subscribers and welcome to my new viewers. If you're new, please click the subscribe button. And tonight, we're going to talk about a few stocks. We're going to look at a few stock patterns to look for. As you can see, I'm looking at my Robinhood right now. I've got Ford, Apple, Airbnb, and ConocoPhillips. And right now in this market, it's looking like only the tough will survive. So I got some ConocoPhillips. That's an energy stock. I've got Apple, a company with a $3 trillion market cap. And I've got Ford Motor Company, which is the new EV play, which they're shipping out the electric F-150 coming this spring. So these are three stocks that are really faring well, okay in this market. Yes, they've taken a dip in the last few weeks, just as many other stocks have. And so I just wanted to go over a few stocks. If you look at Apple over the last year, it has progressed over 13%. And even through the tough times, this may have been flat, but it steadily increases. That's the best thing you ever want to see in a stock, that, yes, it has some dips, but it steadily goes up over time. I call it the stair step. So that's what you want to see in a stock. And Apple has that. As you can see, they have a 52-week low of $116 and a 52-week high of $182. So not that much far off from the high of 182. At right now trading at 162. So that is Apple. And again, you'll see that in Ford. Same pattern, more of a stair step approach. Since January 2021, the stock has steadily increased over time. Sometimes it's quarter by quarter in which they take the next leap up. And, again, it has a nice flow to it. Ford has a 52-week low of $10 and a 52-week high of $25. So right now, I think Ford is at a good sweet spot. It's not at its peak of 25. And then if you go to Tip Ranks or any of the other forecasting stock sites, it'll tell you that the stocks is expected to go anywhere from $25 to $32 per share in the next 12 months. But now I'm going to cover two stocks that they fooled me this year. They were very hot and they did very well at some point because of the current market change. They fell. So here we have Affirm Holdings. It has a 52-week low of $46 and a 52-week high of $176. So this stock is not even trading at a third or barely a third of its most highest value. So if you can see a stock that does something like this, it just peaks up really fast. Back in late August, it just took off. And after the hype, it just crashed. Basically, Affirm is a company. It's a fintech. It was great during the year. They merged or they partnered with Amazon, and they had a few other partnerships, and the stock just took off. The only problem is they have their success is based off of future revenue. That means like 1 or 2 years out. So the stock has plummeted back to its previous before the partnership. So all the way up until like August, they had not come out and partnered with Amazon and a few other major partners. I think Walmart was another major partner. And the stock took off once they partnered. There was all this excitement. It was revealed they were working with Amazon. They went through the Christmas season, and then the stock fell apart once the Fed started raising interest rates. So this is not the pattern you want to see in a stock for it to just take off really quickly. Within 2 months' time, the stock basically doubled. Now there's some people they do trade for a month or two. They get in a stock, and if it goes up, 50%, they exit it. So that could be a strategy. But if you're playing long term, the way Firm has grown over the last year, it's not been very good. As you see, it just returned to, I guess, what some Wall Street analysts expected to be a $60 share, and right now it's trading at $60, $57 a share. So we'll see what happens if they have an earnings call pretty soon. Maybe they can, plead their case to the Wall Street analysts and explain why they deserve to be valued at more than $60 per share. But right now, it looks like the current stock price of $57 is just reflecting of what Wall Street thinks the stock is worth, based on the current conditions with higher interest rates coming by the Fed. The stock has fallen off dramatically. And again, you'll see the same pattern with Upstart. Upstart Holdings had the same pattern where basically late in August, there was a lot of new information coming out and the stock took off. And as they had the earnings call, they had overestimated things. The stock has been re-rated and the stock has fell back down to not necessarily IPO, because the IPO price of Upstart is about $50. As you see, the 52-week low is $42 and the 52-week high is $401. So again, this is another stock that Wall Street basically downgraded, and also due to the current interest rate environment, many stocks that don't have real earnings revenues for this year and may have been projected out in the next 10 years of business are getting re-rated or downgraded in this case. So Upstart has lost considerably in the last month, over 30% value in the last 6 months. So yeah, in the last month, they've basically lost over 30% value. So I would just stay away from, some of these stocks like Upstart and Affirm right now, as they come into their next earnings call and they justify their current stock value. The stock can come back up, but I think right now in the current market, they're not going to work. Okay, and then with AMC, if you go to any Wall Street analyst, it will tell you that the stock is not worth, $40. As you can see, the stock earlier this year at a 52-week high of $72 and has a 52-week low of $2. If we just go to tip ranks and we look at the chart of AMC, you will see that even the analysts say straight, give you the facts about AMC. This is not just because people on Facebook, just because people on Reddit say a stock is good does not mean it's good. The best place you can tell or get an idea where a stock is going is come to tip ranks, type in the ticker symbol, and get the information yourself. So here it is on tipranks.com. 4 Wall Street analysts believe AMC, the average target price is $8.17. So this is how you determine whether a stock is even worth, your money at getting into. I mean, yes, there was people that got it, at $10. I was one of those people. I bought it at $12. I didn't think it was going to do anything, and it went up to $40, but I sold it. I didn't wait around for the party to be over. So I mean, just remember, just because Reddit says a stock is valuable does not mean it's valuable. Use tools like tip ranks, and also I have another place that I like to use. It's called stockcharts.com. It's a great place to look at stocks. So in this case, we're looking at Ford. And as you can see, looking at the technical analysis, you can see this is where the stock should trade, anywhere along this line. And then as always, this is the RSI. The stock should trade between 30 and 70 RSI. If you see it bump it up over the RSI, this is called the resistant index, then that's when the stock is overvalued and it should fall back in place. But right now, if you look at Ford, it should be trading around $20. So again, you could use other charts. This is technical analysis here to determine where a stock should be. If you look at Apple the same way, you'll see it has a nice chart. Again, it follows this blue line. Pretty much over time, the stock has steadily increased. And again, it's between this 30 RSI. Here's RSI. Resistance between 30 and 70. Sometimes when a stock is trading high volume, but it'll bump up over it. But overall, pretty much this is the way this chart should look if you're investing in a decent stock. Now, again, I'm going to show you the stock chart of Upstart and just show you the horrific difference. It looks like it does. This stock has fallen through the blue line and it's fallen through the red line. So this stock has really fallen off. And this is when, I mean, this is a stock I probably should have got out of probably somewhere around here back in early December. But if you look at stockcharts.com and you type in your ticker and the chart looks like this, it's probably not a good idea to be buying and it's maybe time to get out of the stock. So this is just a few tips on what a stock, should look like. Apple being the example. And again, Ford right now is setting the example with growth over 80% in the last year. Wall Street is trying to calm down this stock because it was up over 100% and they're just, they're working it. But, a stock like Ford, it's not bad. It's got a lot of products in the pipeline. So I'll go with the 70% over the last year. But when you see stuff like Upstart did over the last year, where it went up over 100 and I don't know, it was up over 110%. A lot of people got burned, and this is because they don't have actual real earnings for the current quarter. They have future earnings, but this is just the difference in night and day. So whenever you need help looking at stocks, use stockcharts.com and also tip ranks. So that was my tip for the day. I want to thank you for watching. Thank you for listening. Please like, share, and we'll see you on the next video.